Remember, in 1980, the Fed funds rate was 20, and I had a loan outstanding from a bank at 22 and a quarter. 40 years later, the Fed funds rate was 0, and I had a loan outstanding from a bank at 2 and a quarter. So the decline of interest rates by 20 percentage points over that period was a dominant factor in the most important single event in the financial world in the last 50 years.
I believe it was the most significant single event in the financial world in the last 50 years. A sea change is a complete transformation, a radical change of direction, and in the economic world, we are currently experiencing one. In fact, according to some of the most respected figures in finance and economics, the investing landscape has completely shifted from what most of us have known throughout our lives. So, what is this sea change, and how should your investment strategy differ from what has been effective over the last 40 years? From 2009 to 2013, the Fed brought the Fed funds rate down to 0 to combat the global financial crisis, leaving it there for an extended period without much success in bringing it back up to what might be considered normal ranges. Every year brings new developments in financial markets, whether it's a regional banking crisis or a multi-billion-dollar crypto fraud. But there are also large-scale changes, what Howard Marx refers to as sea changes, and we have just reached a turning point in one of them. We have been in a low-interest rate environment that made life quite comfortable for borrowers and asset owners.
Funds rate to 0 to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges.
Reference Silicon Valley Bank talking about the easy money environment. The key point of this sea change is that we are no longer in an era of easy money. The past 40 years in financial markets have been characterized by two distinct states of interest rates. A 30-year period of continuously declining.
A low interest rate environment which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy
of the companies within the index. In 1980, the earnings per share of the S&P 500 index was about $15. Today, it stands at around $175, marking a 12-fold increase. While the rise in the stock market over the past 4 decades is largely due to companies earning more profits, the impact of interest rates has been equally available on fixed income securities like U.S. government bonds also dropped, prompting more individuals to turn to the stock market and be willing to pay more for assets. Investors today are more willing to pay higher prices for stocks compared to the past. This shift is evident in the price-to-earnings (PE) ratio of the S&P 500. In 1980, the PE ratio was around 7, meaning investors were willing to pay 7 times more for the S&P 500 than the profits those companies generated. Today, this ratio has expanded to about 23 times, largely due to declining interest rates. This trend has propelled the stock market's significant growth over the last 4 decades. Consider this, $1 invested in 1980 has now grown to $40. This increase is attributed to corporate profits, which pushed the value to $12 and further amplified by declining interest rates, boosting it to $40. It's safe to say that the environment of decreasing interest rates has significantly boosted investor returns. One could argue that a portion of the rise in corporate profits during this period is also a consequence of lower interest rates. In a scenario where a person contemplates buying a company with a projected 10% annual return and can borrow at 8%, invest at 10%, making it a favorable deal. However, in a low interest rate environment, the company tends to perform better, yielding returns exceeding 10%. With borrowing costs dropping from 8% to 6% or even 5%, it becomes cheaper to finance such ventures. This leads to increased consumer spending, higher business profits, and cheaper investments in expansion and growth. However, this favorable interest rate environment might be changing. The era of continuously declining interest rates for 30 years is unlikely to persist. We could potentially face moderately high interest rates or even a period of rising rates, contrasting the trend of the past 4 decades. Such environments could pose challenges for businesses, hindering corporate profit growth and leading to a possible contraction in the PE ratio of the S&P 500.
He says, oh, we can buy this company and make 10% a year. And then he turns to his capital markets person and says, what will it cost to get the money? We can borrow at 8. Borrow at 8, invest at 10, great, we do it. You buy the company, but in the in the stimulated environment of low interest rates, the company does better, you make more than 10. Your cost of money declines from 8 to 6 to 5, and it costs you less to borrow the money, and you say, boy, I'm a genius.
Most bankruptcies or defaults stem from the inability to meet financial obligations, often due to maturing debts. Bankruptcies don't simply arise from unprofitable businesses. They typically involve unprofitable enterprises unable to secure the necessary capital to cover losses. During periods of easy credit, companies might thrive even if unprofitable, sustaining themselves by continuously refinancing debt, a phenomenon known as zombie firms. Surprisingly, a considerable percentage of publicly traded companies, approximately 10%, fall into this category. However, the tide may be turning for these zombie firms. In the current climate of rising interest rates, refinancing and rolling over debts into cheaper alternatives might become challenging. Higher interest rates could make it harder for these companies to secure favorable lending terms or even access credit at all. This shift could lead to an increase in defaults, particularly in sectors like buyouts and real estate, with concerns about potential defaults in commercial real estate, especially in major cities. For businesses and households alike, fixed-rate borrowings with longer maturities can provide some insulation against immediate impacts of rate hikes. The repercussions of rising rates may unfold gradually over several years, affecting businesses' cost structures and financial health. Given the prolonged period of declining or ultra-low interest rates since 1980, many have come to view this as the norm. However, this era might be undergoing a significant shift, signaling a crucial turning point. Investors need to acknowledge this potential paradigm shift and adjust their investment strategies accordingly. If this change unfolds as anticipated, the composition of
Bankruptcies don't occur because you have a business and it loses money, goes away. It occurs because a business borrows money, times get tough, and when it goes to refinance that loan, nobody ever repays their debts. They just refinance it. And when they go to the bank to refinance it, the bank says, you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher. So it really comes from most bankruptcies or defaults are associated with a maturity which is unmet. And I think that when you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder.
It might sound ridiculous, but
However, delving into such investments requires expertise in analyzing them effectively to make informed decisions. Higher interest rates generally translate to higher yields across various investment avenues, reducing the necessity for heavy reliance on the stock market to generate substantial returns. One prevalent investment mistake often made by individuals is the belief in their ability to predict the future accurately. The unpredictability of macroeconomic factors, as evidenced by the Federal Reserve's frequent misjudgments on inflation, underscores the fallacy of relying on future forecasts for investment success. A robust investment strategy should be capable of weathering uncertainties without banking on crystal ball predictions. Another common misconception is the assumption of a direct cause and effect relationship between company events and stock performance. In reality, market reactions to events are mediated by human psychology, introducing a layer of complexity that goes beyond mere event outcomes. Successful investing requires an understanding of these psychological nuances, as markets are not purely driven by quantitative data but also by human behavior.
Defaults in buyouts or real estate, it's often thought that commercial real estate in big cities is going to have a lot of defaults in the debt.
Yes, well, I think the way I sum it up in further thoughts, I say, you found a company to buy, you went to the bank, they said, we'll lend you $800 million at 5%. Now the loan is up for renewal, you go in, they say, fine, we'll lend you $500 million at 8%. So you have less money and your cost of capital is higher, and you have a $300 million hole that you can.
And leveraging strategies that play to individual strengths in a market environment influenced by both data and human behavior. $100,000. What should you do with it? When individuals seek financial advice, it's akin to consulting a doctor. Just as a doctor inquires about your condition,
You came into this business since 1980, which is almost everybody. You have only seen declining interest rates or ultra-low interest rates. People tend to say, well, that's what it's been for 40 years, that's normal, that's what it's going to be. But no, you have to recognize That's why I call this sea change, because you have to recognize this is an important pivot. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has.
It's vital to tailor investments to your unique situation. One common red flag among content creators is their generic investment advice, which often indicates a lack of understanding of how the investment landscape truly operates. Instead of relying on such sources, consider using comprehensive portfolio tracking tools like Charit. Charit goes beyond basic data to consider factors like capital gains, dividends, fees, and currency changes, providing a holistic view of your portfolio's performance. It tracks various asset classes, including stocks, ETFs, commodities, and cryptocurrencies, simplifying...
You know, the S&P has returned, S&P 500 stock index has returned 10% a year plus, just a little over 10, for 100 years. That was enough to turn $1 in 1920 into $15,000.